Mortgage rates have reached 20-year highs and the housing market is collapsing according to the most recent data. The cost of home ownership in America has never been higher. By this point, potential home buyers have run out of options, which explains why over the past 8 months, home sales have been steadily declining and sellers are being pushed to lower prices as demand declines. Renters are simultaneously dealing with an even greater financial hardship. But things aren't much better for homeowners. Since the start of the crash, they have already lost $1.3 trillion in home equity, and the number of borrowers who are currently in danger of going underwater has more than doubled. An economist warns that this is going to be even worse than 2008, and we should all buckle up because it's going to be a wild ride. Welcome to the Financial Flow. Please like and subscribe to our channel and turn on notifications to stay up on our latest videos. As rising mortgage rates frighten away potential purchasers and hasten the housing decline, homeowners are put in grave danger. There are crisis signals everywhere. According to the most recent statistics, home sales have fallen for 8 straight months, which is the longest dip since 2007. The October decline was 25%. The number of new home listings decreased by 22%, and home building starts also decreased. The Federal Reserve recently increased mortgage rates to 20-year highs of 7.23%, which has dramatically reduced demand and contributed to the housing market's decline. This scenario is unsustainable and unhealthy. Policymakers need to address the challenge of rising home affordability. According to estimates, every rate increase drives an additional 9 million potential buyers away from the market. Buyers are holding off because of the rising anxieties about the crisis and their perception that 2008 might be repeating itself. As a result, merchants will be compelled to further reduce their prices in order to react to a market where consumers' purchasing power is substantially smaller than it was a few years ago. By the beginning of 2023, the first wave of price spikes is anticipated to cause a 20% crash. All indicators point to a nationwide acceleration in the downward trend in housing prices. Over the following 12 months, the property market will experience the second largest decrease in price since 1945. For the wealth and equity of homeowners, that will be disastrous. The area of the economy most affected by interest rates is the housing market. It is directly affected by the fallout from the measures to reduce inflation. The housing market will experience a nationwide decline. It's going to hurt like hell. The market as a whole is not immune. Economists point out that in order for the Fed to reach its inflation aims, a horrible financial crisis will have to take place. As a result, the central bank is unafraid to crash the stock and housing markets. They want home prices to decrease as well as the stock market to decline. The Federal Reserve has been working harder to reduce inflation from recent rates of 8 to 9% of its target of 2%. Right now, there is a significant housing bubble. The majority of a household's balance sheet is made up of equities and residential real estate. The risk of losing everything is extremely real. Even buyers who set their sights lower to cheaper houses will still have to make larger mortgage payments as the sharp decline in home sales just started. To return the price to incoming ratio to what it was prior to COVID, we anticipate a decline of 20% by the beginning of 2023. Housing is, in a word, falling to zero. The sales volumes have taken the biggest damage thus far, but prices are also falling today, and they still have a long way to go. The confidence of homeowners has also drastically declined, according to economists. For the 10th straight month, October saw a decline in home builder confidence, which brought it to its lowest level since 2012. Mortgage rates have increased to levels not seen since the Great Recession in the most recent downturn scenario. The survey's results were appalling, and they show that the current downturn in the housing market has not yet reached its bottom. By the beginning of the year, at the very least, rising long-term rates will probably cause a collapse in home prices. Americans will be startled when things have gone too far, and there is no turning back because this is a housing slump. The nationwide increase in housing prices of 43% in just 2 years is absolutely abnormal, and has simply increased monthly payments above what the majority of people can afford. But the day of reckoning didn't linger for long. The housing boom has quickly evolved into a bust that is now spreading. Recent data from Fannie Mae shows that in some formerly hot markets, prices are dropping by as much as 4% per month. Purchase-related mortgage applications are regarded as the best predictor of upcoming sales that will close in the coming months. They have decreased by 42% year over year and are further declining each week. With almost 1.7 million privately owned homes currently under construction, a tsunami of new supplies is about to hit the market as demand declines. This breaks the previous record, which was achieved in 2006. Homes are up to 75% overvalued, which is much more concerning than stagnant income and increasing mortgage rates. The fundamentals of national housing will be unparalleled because of the current housing correction. The country's more expensive regions are particularly feeling the pinch and experiencing greater sales declines. Prices in booming markets like Boise and Nashville may drop by 66 to 73%. Home values may drop by 25 to 30% in relatively chain markets. All around the United States, prices are inflated. And if you read between the lines, the Fed is telling you exactly where things are headed. Even while the property market may be inflated once this crisis is finished, many people will experience severe financial hardship. Given all of this concrete data, it is understandable that consumer confidence in the US housing market has dropped to its lowest level ever. Only 16% of consumers said last month that they think the current housing market is favorable, the lower number since the survey's inception in 2011. Institutional buyers will gain from the Fed-induced decrease in property prices, while former homeowners will be priced out of the market. 40% of all single-family rental homes in the US will be owned by institutions by the end of the decade. In the years following the 2008 crash, large-scale investors seized the opportunity presented by this wave and the subsequent rise in rental demand from displaced former homeowners. In 2012 and 2013, investment companies began acquiring single-family homes that were in foreclosure. Many of them come directly from banks in significant numbers. Given that the majority of institutions are buyers with cash on hand, the pattern will probably worsen throughout this downturn. Since then, 40 million more Americans have become unable to afford to buy a home. In other words, the average American won't benefit from the mess the federal government and Federal Reserve are creating to control the inflation crisis they caused. In the long run, it won't make our lives any simpler or better. Rather, we'll only become more exposed to the housing feudalism that is taking over our country. Additionally, our home status will never be completely secure. Take a look at how many homeowners are currently being threatened with eviction by those institutional purchasers. In the next 2 months, 3.6 million renters, or 6 out of every 100 tenants in the US, face eviction, according to Legal Services Corporation, a federally sponsored legal aid organization. In half of the 1,059 countries the group was tracking, evictions were already on the rise and were higher than their historical averages. The company also discovered that over the previous year, 2.5 million people had their rent increase by more than $500. For low-income renters, the situation is considerably worse now than it was before the pandemic, when we were already facing a crisis in access to affordable housing due to inflation and the dramatic rises in rental prices over the past few years. People's inability to keep up with rising rents and the skyrocketing cost of living is projected to make the problem worse in the upcoming months. It's going to be a very difficult period from now on. The worst of what is about to happen is probably just around the corner. Whatever happens, it will only get harder to find affordable housing. Americans are feeling helpless and overwhelmed. And if this sounds all too familiar, it's because it has happened before. However, the current crisis will grow to unprecedented proportions in the upcoming months. Thanks for watching. Don't forget to leave a like and subscribe to our channel for more content like this. Have a good one.